Welcome to Bloomberg Invest. I'm Sonali Basak. We're going to hear from some of the top names in asset management, banking, wealth, and private markets. They are the industry's most influential voices who know how to build empires, protect portfolios, and create the next big thing. And when they spoke at the Bloomberg Invest event in New York at the beginning of March, President Trump's favorite word was at the top of the agenda, and that's tariff. Almost every CEO is gauging what an unpredictable Trump administration would mean, given trade and economic relationships are shifting drastically around the world.
I think the administration inherited quite a stable economy. Inflation obviously not exactly where the Federal Reserve would like it, but it's come down dramatically. And so the environment feels quite good. Now, in terms of what we're seeing in that data, there's nothing suggesting today that the economic underpinnings of that have shifted dramatically at all. What you're starting to see, though, are the things I just described, which is preemptive actions around how best to position, again, around the uncertainty. The way I would describe it is for a long period of time, geopolitical economic risk tails were very tight. They're just fatter today, and we'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean. But this uncertainty factor obviously is affecting markets.
Where do you see the direction of travel? More recent economic data has created some cause for concern among investors.
I think the Fed has done an extraordinary job. I think at this point, given we don't exactly know how the tariffs will ultimately settle, I think the inflationary question is a bit uncertain. So what I mean by that is there is a path where you could see a one-time bump in prices, assuming there's no trade war and no future escalation, that will translate through the system as higher prices. It may also cause some demand destruction, which longer term would be deflationary. And you actually could see the economy experiencing stress as it goes through that. So I would say that all the parameters around forecasting inflation, forecasting interest rates, I said, again, I just think we should all buckle up a bit because markets will be more volatile, super data centric, probably too data centric because you can't extrapolate one data point to the future, but it's going to be a sort of a wait and see. I do think the administration will be very sensitive to pro-growth policies, and so I think they'll be watching also.
I think the one thing that market participants maybe have underestimated, in the first term we all said Trump is very SPX sensitive, and that was invariably the truth. I think with Scott, I think their pain tolerance is different, and I think they're more sensitive to a broader set of asset classes, and I think they might believe that ultimately they have more levers to pull when and where they need it. That said, when you think about tariffs, we can all look at a textbook and we can say, and I think the Treasury Secretary said it today, manufacturers will absorb the price pressure, and then you can also argue that it's a one-time price shift. But I think what you can't control is consumer confidence and corporate confidence, and I think that is what is falling off a cliff right now.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet because, again, I think ultimately they will bear more pain than I think market participants originally thought, but there will be a limit. And I think they will make deals.
I've spent my entire career focused on fiscal discipline. We balanced the budget in 1998, first time in 30 years. I think we knew what the heck we were doing. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government and to the recipients of government services and government activities. Now, are there excess expenditure? Are there inefficiencies and is there excess regulation? Yes, but you approach it with a rational cost-benefit analysis, not a burn and the burning down of what exists, and then the thought that you rebuild it. And I think we really are doing tremendous damage to government and to our economy.
As you think about the world, geoeconomically and geopolitically, the anchor, the sacrosanct anchor that the U.S. has is rule of law. It has never been a factor in any conversations that we've had up to this point.
Is it a factor now?
it is moving into the conversation in ways that we haven't visited historically. So we need to be very mindful of conversations that today, it is not central to the conversations, but it has now become part of the conversation where historically it hasn't been. The randomness that appears to be at play here is not one that gives boards and CEOs a lot of confidence. So whatever the new normal is, will they react? The answer is they will react whenever we get there. If it's a new normal of continued unpredictability, then it's not quite certain how aggressive people are going to act. So I would continue to pay attention to the volatility index. I would continue to pay attention to the 10-year Treasury, which I think what the administration is currently looking to as guidance, and see if we get to a new normal, what that new normal looks like. It's not clear yet.
I think what we have to try and figure out is what is the objective of the tariffs. And that, to me, I think that's where a lot of us are struggling. Is the tariffs meant to make foreign products more expensive so the domestic product is cheaper? Okay, that's a good use of a tariff. The problem is a lot of the things that we import, we actually don't make here in the United States. So you can make the foreign product more expensive. It doesn't make the domestic product cheaper because we don't have it. So I think we have to figure out what the objective is. If the objective is to raise money for the government, like, make that the objective. I'm not sure how you do that. And how do you do that with weighing the effects of inflation on the other side? And I think you have to think about that. So if we're just using it as a revenue raiser, it creates a higher cost of goods. It's a really regressive way to raise revenue, because I hate to say it, like, it's the reality of it is poor people or less highly paid people consume 100% of their paychecks. Wealthier people consume a very small percentage of their paychecks, and they have to consume their paychecks. So the things that are being tariffed are things that everyday people buy, and it becomes a really regressive tax system. I don't think we want a regressive tax system. I'm the first guy here that's going to argue for a progressive tax system. The rich people need to pay more in this country. They should pay more, and they do pay more today. I don't think we want to flip that around through tariffs. So to me, the question is, what is the objective here? Like, there may be a real robust, bona fide reason to have tariffs. I just don't know what we're trying to achieve.
When you own so many businesses, when you have so many types of debt and equity tied to companies around the world, how do you think about the way this is evolving?
What I'd say is we try to take a little bit of a longer term perspective, that there is tariff diplomacy going on, and that what is happening now could change depending on what market participants, what government officials do. And you've got to take that longer term approach and hope, or maybe expect at some point, that they'll get to outcomes, markets will calm, and actually in a moment like this, you look around and say, are there good businesses that are now on sale? We can deploy capital into this volatility. So I would just say to investors, be a little bit patient here. Let this tariff diplomacy play out a bit.
How do you think the tariffs are going to affect the economy? Why does President Trump like tariffs so much?
Well, the president's been very focused on tariffs for a long time. And he fundamentally believes it's a good source of revenue and that it's impactful in getting people to change behavior. And that's what we're seeing today.
Okay. All right. So you think that tariffs will be ultimately good for the U.S. economy, I assume? You have a similar view?
Well, I think the market really wants certainty and understanding certainty and will adjust to whatever they are. I think the problem right now is we don't have certainty. My own view on the tariffs would be that if he wants to do something, I like the idea of the 10% tariff across the board. It's a consumption tax on foreign goods. But if he were to do that, he should do that through the reconciliation process, so that can be scored, I think would raise about $2.5 trillion and could be used to pay for tax cuts, as an example.
Coming up, when the word of the day is uncertainty, where is the smart money looking to invest?
More people have seen Bigfoot in the last, decade and a half than a business cycle, most likely. And that means all of us are to some degree asleep.
Welcome back to Bloomberg Invest. I'm Sonali Basak. Investors face uncertainty at home and abroad. From Wall Street to Main Street, every move counts. At the Bloomberg Invest event in New York at the beginning of March, we spoke to some of the industry's most influential voices. Uncertainty could be a killer for economic activity and for CEO confidence, but volatility could also create chances for big gains in the markets. Investors managing tens, even hundreds of billions of dollars say that they're also looking more to private markets to find alpha.
Private credit rose up from this idea that middle market companies should have access to loans to be able to do deals, and the success of that built on it and built on it. And I think what you're seeing now is as private credit succeeded and got into bigger and bigger deals, the line blurs as to what is an obvious private credit deal versus an obvious BSL deal, and it allows, I think, a lot of flexibility for borrowers to figure out what's best for that individual company. If you think of really what the definition of private credit is, from a norm perspective, it's that not too many people are in the loan, that you know who is in it, and then most importantly, if something goes wrong, your lenders are going to think about it as a relationship, as a repeat player, and they are going to work with the sponsor in a conciliatory way to deal with the business.
We can't really get to a true business cycle until the consumer rolls over because it's 70% of GDP. The consumer's already in a recession and has been for a while on the very low end of the market, just not the high end of the market. And I think as many people here know, 50% of consumption in the US is driven by the top 10% of the consumers. So you need to see a crack there to really get the business cycle moving. Employment will be part of that. I'd also watch equity markets because this top 10% of the consumer, a lot of their wealth is in houses and in equity markets, and they're transferring that wealth, the baby boomers, to the next generation. So I want to posit to all of you that the transmission mechanism may be a little bit different this time around and come a lot through equity markets. So that's something to watch. I'll end by saying where we interestingly do see some opportunity, even in the absence of the business cycle kicking in or a recession, is in rescue finance. So that is where we are deploying record amounts of capital. And that is because interest rates have stayed high because of inflationary pressures. You've got a lot of companies with upside down capital structures. The operating business is okay. The balance sheet is not, and there's an opportunity to go in there, restructure, and ultimately deliver equity-like returns for our clients through the credit.
Katie pointed it out well, right? We've seen more people have seen Bigfoot in the last, decade and a half than a business cycle, most likely. And that means all of us are to some degree asleep. And if you think about the way private markets operate, they don't get marked routinely. And so you could sit around in a private portfolio for a long period of time and think there's no trouble under the surface whatsoever and have really no incentive to kind of dig for that trouble under the surface. And so one way to maybe think about the convergence is not merging public and private markets, but what you might want to think about is what's going on, what are the public markets telling you that help you underwrite in the private market?
Is globalization a diversification play? Is it a safety trade? How do you think about it?
Well, we are a very, very global firm, and we have a lot of different ways to participate in those opportunities. Private equity, real estate, private credit, and infrastructure. So in really volatile periods like we're in right now, having that flexibility of capital, we could partner with companies, management teams, as a provider of anything from senior investment grade debt, right, to non-investment grade debt, to structured credit solutions, structured equity solutions, growth equity capital, to buyout capital. So, today it's an interesting market. When volatility spikes, that usually leads to really, really interesting deployment opportunities for our firm. You need to be nimble. You need to have the local reach in all these different markets. But we're excited, quite frankly, about 2025. There are going to be hiccups. There's going to be some headwinds in terms of some of these macro policies. But our ability to deploy scaled capital around the world, we think, is quite high.
I will still ask you, if not dead, then is American exceptionalism then overblown?
No, listen, I think this notion that the U.S. is going to win alone has never been the case. I think the strength of the United States is really the resiliency of the economy, the strength of our capital markets to mobilize capital to support companies in the private sector, and labor productivity, right? When you think about why the U.S. has grown faster than Europe or faster than Japan, it's really about labor productivity in the United States. A lot of that is technology-driven and innovation-driven, but a lot of that is our unique mobility of labor in this country.
I do think this is a time to prepare for kind of situational dislocations and maybe even systemic distress in different pockets of private markets, right? I think you have such a large share of venture-backed companies with less than a year of cash runway. You have pockets of distress, obviously, in real estate, and even in private credit land, you're starting to see some pretty big issues kind of emanate. And so I do think it's really difficult to really kind of plunge and really invest in a falling knife type environment. But I think it's really important for everyone, as there's increased geopolitical and macro volatility, to kind of prepare for some
And this
of
has
those
been unfolding for a while. I mean, we saw a drop in allocations at the start of 2024 into private markets. Steve, though, you leaned a little bit into that. You're actually expanding your
Yeah, I mean, we actually had a change in legislation and impacts the city of New York. So we're actually, we are in the process of increasing our exposure to alternative or private assets from 25% to 35%. I'd say the average allocation across our 5 plans is between 10 and 12% private equity. So it's been an advantage at a time when everyone else is pulling back and exits have been harder to come by. Performance hasn't been great in private equity, but I think it's a great time to be putting money to work. We were able to get better access to the top decile performers, to get size and scale, to negotiate better terms, better economics, and a healthy slug of co-investment as well, typically no fee, no carry. So those are things that I think will positively impact the portfolio longer term, 3 years, 5 years, 7 years out.
If you have such a vast private market, what do you do with that? How do you get more investors access to that?
So you nailed it. Any prediction in terms of the sustainability and durability of private capital suggests it's going to keep compounding at 10%. So it'll be a $25, $26 trillion market before we blink in terms of private capital. Now, what's happening is there are a lot of forces in the system that are driving more capital to private markets, demand from insurance clients as they look for private investment grade. And of course, the biggest factor is what's happening in wealth. And really, if you look at whether it's 1%, 2%, 3% of portfolios in wealth individuals' portfolios today managed by people in this room, then if that grows to 5%, 6%, 7%, we're talking about an enormous trend. And I think the stats on US pensions, for example, 40% are in alternatives. Ultimately, retirement accounts will be in private capital. It's the perfect balance of liability and return, and it gives investors diversification. So
401ks?
Ultimately, yes, for sure. Pace of which, hard to predict. But the wealth transition to private capital, for sure, is a durable transition. Should be. The asset class makes a lot of sense for a lot of people. We've scratched the surface globally on wealthy individuals participating in these markets, so that capital stream will continue to come in.
Coming up, the race for artificial intelligence supremacy, looking for winners and losers.
There is a bunch of money being spent today that will have very low returns to no returns. But if you don't start investing, you'll never start.
Welcome back to Bloomberg Invest. I'm Sonali Basak. Trillions of dollars are expected to be needed to fund the artificial intelligence boom around the world. But there are risks to how it all plays out, and investors are trying to find the winners, all while avoiding investments that might lead to big losses in years ahead. At the Bloomberg Invest event in New York at the beginning of March, we spoke to some of the industry's most influential voices and heard how the intersection of AI and investing is opening up new opportunities for growth.
As you're building technological infrastructure and backbone, you're building it based on what's available today and what you know today. The whole AI backbone, infrastructure, compute, technology, it's moving very fast. But you can't wait for version 2.0 or version 3.0 or version 4.0. You have to build based on what's available today. What's available today will be obsolete a lot of it before it gets built, and it will get replaced by newer and newer versions. So there is a bunch of money being spent today that will have very low returns to no returns. But if you don't start investing, you'll never start. So you sort of have this prisoner's dilemma that I have to start building this data center, and I think I'm going to be putting XYZ chip in. But by the way it gets built in 2 years, I may not be putting, I most likely will not be putting that chip in. And the amount of power I think I need to run that data center may be dramatically less, because the next chip, I bet, is going to be a lot more efficient than the chip we have today. So a lot of this build, you can't wait for the efficient frontier, because someone's always going to be out there. You have to keep building, and there will be a lot of waste to get there. I just think it's inevitable. And then, these AI models themselves are going to build upon themselves, and they're going to get smarter and smarter, and they're going to optimize and re-optimize, and everything's going to get better and faster and quicker. And ultimately, the AI of the data center is going to tell you how to build a better data center, how to build better connectivity, how to optimize the optimization.
Digital infrastructure has been a huge theme for us. Data centers, we've been the leading investor in the world in that area. There's obviously been concern given DeepSeek, but we continue to see big demand throughout that whole sort of value chain. We love power and energy. We think we're moving to a world of very heavy electrification. It's because of data centers, reindustrialization, robotics ultimately. We invest in generation, transmission, utility services.
In the world of real estate, which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
It's an interesting question. I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically. And we think the usage is going to go up. There may need to be a little less training, and it may be more inference, but our lives are migrating online, and I think these data centers are a critical part of that infrastructure. So I'd say I like both of these children.
So on data centers in particular, the estimates are staggering. But they're not only staggering, they're all over the place. You've seen estimates from a need for $1 trillion or $3 trillion globally to build data centers. You've seen estimates higher than $10 trillion. Both things can't be true.
Yeah. Well, I think it's a question of what you're measuring. If it's just the physical data centers, it's probably on the lower end. But if you're talking about the GPUs that go in those data centers or the power that needs to go, then those numbers get really large, and then I'd be at the higher end. And it's a global phenomenon. I mean, if you think about where the world's going, I think our lives are going to be so impacted by this technology. What we do, how companies function, coding, customer engagement, even things like translation today now. You don't even need translation anymore because the machines can do it real time. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant. I'm not astute enough or knowledgeable enough to know exactly what the number is, but it feels like it's going to be very big.
And that's just a taste of what we had at Bloomberg Invest this year. And you can find much more on Bloomberg.com and on the Bloomberg Terminal. I'm Sonali Basak in New York, and this is Bloomberg.